Gold doesn't need to whip the US dollar. Gold doesn't need to break the treasury market. All it has to do is revert to mean. If it reverts to mean, the market share in the US market grows fourfold. Now, can you imagine what a fourfold increase in demand for gold and gold stocks in a market that controls 23% of the savings and investment assets in the world would do to the gold price?
Rick Rule, CEO of Rule Investment Media, says this shift could push gold prices to over $10,000, and it may be closer than you think. Rick points out that gold is ignored by 99.5% of the US market. But here's the catch. Gold doesn't need to beat the dollar or break the treasury market. A simple return to its historical market average could send demand and prices soaring. Just imagine, a fourfold surge in US demand for gold and gold stocks. The impact on prices, game-changing. Is this the turning point for gold? Rick Rule lays out the case. Don't miss it. Watch now.
Gold has done a great job, and I'm delighted. Well, I'll give you some arithmetic. If I was on Adam Taggart's show and one of his readers said to me, Rick, when is the gold price finally going to move? I would say to that person, I'd be old and sage, it's going to move in the year 2000. In the year 2000, it was at $253 an ounce. Now it's at $2,600. In other words, it's up, what, sevenfold?
Yeah.
Gold has increased by almost 8.5% compounded for 24 years. It's done exactly what it was supposed to do. It's protected by purchasing power for 24 years. So when you're asking me when gold could have moved, 24 years ago. What I really like about it from an investment perspective is that it has this wonderful track record, which nobody cares about. The market share of precious metals and precious metal securities in the US market, the market that I know the best, is less than 0.5%. Less than 0.5% of savings and investment assets in the United States are precious metals related. The 4-decade mean, according to JP Morgan Chase, not some old bald gold bug, JP Morgan Chase, is that the market share of precious metals and precious metals securities over the last 40 years in the US market has been 2%. Gold doesn't need to whip the US dollar. Gold doesn't need to break the treasury market. All it has to do is revert to mean. If it reverts to mean, the market share in the US market grows fourfold. Now, can you imagine what a fourfold increase in demand for gold and gold stocks in a market that controls 23% of the savings and investment assets in the world would do to the gold price? You know, Bitcoin is what, a $3 trillion asset class? Robert Friedland describes that as a pimple on an elephant's ass.
Yeah.
It doesn't matter. I mean, yes, on the margin, right? The penny stock moron and the crypto moron are very similar species. But if you look at a global market for savings and investments at the $750 trillion level, gold is a sideshow and Bitcoin is a sideshow. They don't matter. The circumstance that will cause the gold price to move is a circumstance where perhaps Bitcoin can be accommodated in the move too. My suggestion is that they serve different purposes. Gold is a store of value and a medium of exchange. Bitcoin is a network and a transfer mechanism. So I think at their heart, they're different asset classes. Right now, they're regarded as momentum. They're regarded as trading vehicles. I engage in conversations here with people about Bitcoin, and I admittedly know almost nothing about it.
They must love you.
And I would suggest that I know substantially more about it than they, and they're advocates. Despite the fact that I know more about it than they do, I profess no knowledge. The real knowledge they have is that they've watched it go from 1,000 to 100,000. That's the whole knowledge. And the fact that the asset class is up 100-fold, they somehow think makes it more attractive. We talked earlier about the unfair division of economic gain. It's unfair because some people work harder, take more risks, and think better. That's the way it works. Sadly, people resent that outcome. Well, I don't know. I don't know where to begin. When they say that there's no capital available, I've probably attempted to get in 25 private placements in the last 2 years, And at least 20 of them were oversubscribed, meaning that I got cut back. And I'm regarded as a value-added investor. Eric Sprott gets cut back. Pierre Lassonde gets cut back. Frank Juster gets cut back. This is not a capital short market for high-quality issuers. The problem is in the junior sector, there's not very many high-quality issuers. It's mostly the lame, the halt, and the blind. We've talked about this on Kitco before. If you merge the whole public company universe in mining to Junior Explorco, one company, worldwide, merge these 2,500 or whatever they are companies into one, that company in a good year would lose $2 billion. In a bad year, it'd lose $10 billion. So you tell me, how much do you pay to lose $2 billion a year? Should you pay 8 times losses? In a bull market, should you pay 15 times losses? The truth is that if you invest in the sector overall, I'm talking about the juniors, over a decade you will go broke. That's what will happen. That disguises the fact that there's a subset of issuers, perhaps 5% of the total population, that generates so much performance that it adds legitimacy and sometimes luster to a sector that loses $2 billion every year. You pointed out to me, and we'll make the company nameless, a junior company recently was successful raising $2 billion and as a consequence awarded themselves $10 or $15 million worth of restricted stock units for doing nothing.
Yeah.
Now,
doesn't work that way anymore.
When the government does it, you call it counterfeiting. Remember that the private sector is always more efficient than the government sector, even when it comes to printing phony paper. A different statistic is we had a young intern many years ago, that's financial speak for slave, and we had this young man pull 25 TSXV companies at random and look at their balance sheets and income statements. And he reported back to me, and we weren't looking for this, he just found it, that the median TSXV company in a 25 company selection spent over 60% of capital raised in general and administrative expense. Less than 40% of the capital raised went in the ground. Now, how's that going to work? Well, the bigger caps, you're starting to see the tale of two cities. There are companies that have done a good job constraining their capital investments to a few projects that they understand and know well. And so you're starting to see real breakouts in terms of operating margins. Agnico Eagle would be a great example. Alamos would be a great example. Wesdome would be a great example. Lundin Gold would be a sterling example. Just blew away estimates. But then you're seeing the others. Newmont has been stubbornly inconsistent with all-in sustaining capital costs, with margins, with sustaining capex. Barrick has had trouble exhibiting unit growth and has had similar problems with AISC. And that needs to be dealt with. The plans, and I'm not hitting Newmont, I'm using them as an instructional medium. Newmont understands the plans and the plan that they have in place to fix it, which is to sell off all of their tier 2 mines. Use the proceeds to strengthen the balance sheet. You'll note they just sold Musselwhite. And focus management time and attention on 5 or 6 mines that have the scale to move the dial for Newmont is the right answer for the problem. But they need to affect it. I believe that they will do it over 18 months, but I'm not going to buy more Newmont until they prove it to me that they can do this. If you take this whole raft of mines that would benefit smaller companies by being the subject of their love, care, attention, and focus, while freeing Newmont management to focus on 5 or 6 mines that make a difference for them. It'll be good for the whole industry, but it has to happen. Until I do that, until they do that, I think you'll continue to see their all-in sustaining capital to be, troublingly high. I think that you will see continually their inability to maintain sustaining capital level investments because they're trying to understand 20 operations simultaneously when realistically they only should be trying to understand 5 or 6. I use Newmont as an example for the industry as a whole.
As Rick Rule explains, the path to $10,000 gold may be closer than we think, driven by a shift in market demand. The question is, are you prepared for what's coming? Stay ahead of the curve. Like this video, subscribe and press the bell icon for more expert insights and analysis on gold, markets, and the global economy. Thanks for watching, and we'll see you in the next video.